Okay, so picture Alonzo Herndon, a man born into slavery in 1858 who became Atlanta's first black millionaire, building his wealth through barbershops and insurance. And then picture the city he built that wealth in, Atlanta in the early 20th century. A city that contained within its boundaries one of the most remarkable concentrations of black economic activity, black institutional life, and black entrepreneurial ambition in the entire United States. A community that built its own banks precisely because the mainstream financial system made absolutely clear, through practice and through policy, that it had no genuine interest in serving black depositors or black borrowers on anything close to equal terms. That history, the specific reasons black-owned banks in Atlanta were built, the structural economics that have always governed how they operate, and the genuine, persistent tensions between their community mission and their commercial survival, is the subject of this breakdown. Because understanding what it actually means to own and operate a black-owned bank in Atlanta, then and now, is essential to understanding one of the most important and most under-examined institutions in the entire architecture of black wealth building in America. Before we go any further, if this kind of breakdown, pulling apart the real economics behind black ownership and black institution building in America, is the content that genuinely helps you understand how wealth and capital actually work, make sure you subscribe to Wealth Forge Black right now and turn on notifications, because this channel is built entirely around showing you the real structure behind these systems, and you will not want to miss what comes next. Now let us start with the foundational context. Because unlike almost any other city in America, Atlanta carries a specific, documented, historically layered relationship with black banking that shapes everything about how this industry operates there today. Atlanta was home to some of the earliest and most significant black financial institutions in the American South, institutions built during and after Reconstruction, in direct, explicit response to the total exclusion of black citizens from mainstream white-owned banks. An exclusion that was not simply in formal practice, but was in many cases legally enforced, socially entrenched, and commercially sustained through a system of deliberate, documented redlining that this channel has examined in detail in other breakdowns. The Auburn Avenue corridor, known historically as Sweet Auburn, was for decades one of the most economically vibrant black business districts in America. Home to insurance companies, newspapers, churches, and banks. A concentrated geography of black economic institution building that emerged precisely because the mainstream economy refused to serve the community those institutions were built to support. Citizens Trust Bank, founded in Atlanta in 1921 and still operating today, is one of the oldest continuously operating black-owned banks in the United States. And its more than a century of operation in this specific city makes it one of the most important case studies available for understanding the genuine, long-run economics of black-owned banking in America. Now here is where the structural economics of banking itself need to be understood at the most basic level, because a bank is a genuinely unusual kind of business, different in its fundamental operating mechanics from almost every other enterprise this channel has examined. And those mechanics matter enormously when you are trying to understand why black-owned banks face the specific challenges they do. A bank's core business model, stripped to its essential structure, involves accepting deposits from customers, paying those depositors an interest rate on their balances, and then lending that deposited money out to borrowers at a higher interest rate, with the difference between the rate paid to depositors and the rate charged to borrowers, a figure the industry calls the net interest margin, representing the primary source of revenue from which the bank must cover all of its operating costs and generate whatever profit remains. This sounds straightforward until you begin to understand the specific ways in which the customer base, deposit base, and loan demand that a Black-owned community bank in Atlanta serves creates structural pressures on that net interest margin and on the overall financial performance of the institution that a larger, more diversified mainstream bank simply does not face to the same degree. The deposit base is the first structural challenge, and it is foundational to everything else. A bank cannot lend money it does not have, meaning the scale, stability, and cost of the deposit base fundamentally constrains and shapes the lending capacity of the institution. Black-owned banks in Atlanta, like Black-owned banks across the country, have historically served a customer base whose average deposit balances are lower than those of the broader banking population. A direct consequence of the wealth gap this channel has documented repeatedly across industry after industry, the same accumulated, generational wealth deficit produced by decades of exclusion from home ownership, from business financing, from professional opportunity, and from the compounding returns those assets generate over time. Lower average deposit balances mean that serving a given number of customers requires proportionally more operational infrastructure, more account maintenance, more teller transactions, more customer service contact, relative to the total deposit volume those customers represent, pushing the per-dollar cost of deposits higher than at institutions serving wealthier customer populations. This is not a theoretical concern. It is a documented, measurable reality that shows up directly in the efficiency ratios of Black-owned community banks when compared to larger mainstream institutions. And it represents a structural cost disadvantage that is genuinely difficult to overcome through operational improvement alone, because it is rooted not in management failure, but in the economic circumstances of the community the bank was built to serve. The lending side carries its own distinctive structural challenge, and it is here that the community mission of a Black-owned bank comes into the most direct, genuine tension with its commercial survival requirements. The communities that Black-owned banks in Atlanta serve, communities in areas like South Atlanta, Mechanicsville, Vine City, and the broader Southwest Atlanta corridor, are communities where mainstream banks have historically been significantly underrepresented, where access to conventional mortgage lending, small business financing, and personal credit has been genuinely, measurably harder to obtain than in wealthier, whiter parts of the city, and where the demand for exactly the kind of accessible, relationship-based, community-oriented lending that a Black-owned bank is uniquely positioned to provide is genuinely significant. The challenge is that lending in these communities also carries higher measured credit risk than lending in more affluent areas. Not because Black borrowers are inherently less creditworthy as individuals, but because the economic circumstances of communities shaped by decades of disinvestment, redlining, and structural exclusion produce lower average incomes, higher unemployment vulnerability, lower existing asset bases to serve as collateral, and greater sensitivity to broader economic downturns, all of which translate into higher loan default rates on a portfolio level, even when individual underwriting is careful and rigorous. This creates the central, defining tension of Black-owned bank economics. The community mission demands lending to borrowers and in communities that mainstream banks have abandoned or underserved. The commercial survival requirement demands maintaining a loan portfolio whose credit quality is strong enough to keep loan losses within manageable bounds. To satisfy the capital adequacy requirements imposed by banking regulators, and to generate sufficient net interest income to cover operating costs and maintain the institutional viability that allows the bank to keep serving its community at all. Threading that needle, being genuinely mission-driven in serving borrowers and communities that need the bank's support while being commercially disciplined enough to remain a sound, viable, well-capitalized institution is the fundamental operating challenge that every Black-owned bank in Atlanta faces every single day. And it is a challenge that has no clean, easy resolution because the two imperatives are in genuine, structural tension with each other. If you are finding this breakdown genuinely useful, if understanding the real economics behind Black institution building and Black wealth creation in America is the kind of content that helps you see these systems more clearly, subscribe to Wealth Forge Black right now and turn on notifications, because this is exactly what this channel is built to deliver. And the next breakdown is already coming. Now, the capital adequacy framework specifically, because this is a dimension of bank economics that carries particular weight for Black-owned community banks, and that is worth understanding in genuine detail. Banking regulators, primarily the Federal Reserve, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corporation, require banks to maintain minimum levels of capital relative to their risk-weighted assets. A framework designed to ensure that banks have sufficient financial cushion to absorb loan losses without becoming insolvent and threatening depositor funds. These capital requirements apply equally to every bank regardless of its ownership, mission, or community orientation, meaning that a Black-owned community bank serving a lower-income community must meet exactly the same capital adequacy standards as a large national bank with a diversified, higher-income customer base. The challenge for a smaller Black-owned bank is that raising additional capital when it is needed, whether to support asset growth, to absorb an unexpected spike in loan losses, or to invest in the technology and operational infrastructure required to remain competitive, is genuinely harder than it is for larger institutions. Publicly traded banks can issue new shares in capital markets with relative ease. Large private banks can draw on networks of institutional investors and private equity capital. A smaller Black-owned community bank in Atlanta has historically had to rely on a much narrower set of capital sources, often including community development financial institution funding, mission-driven investors, faith-based institution deposits, and occasionally federal programs specifically designed to support minority depository institutions, a category that includes Black-owned banks, and that carries its own specific regulatory recognition and support framework under federal law. The Minority Depository Institution designation, often abbreviated as MDI, is worth examining specifically because it represents the federal government's own formal acknowledgement of the distinctive role and distinctive challenges of institutions like Black-owned banks, and because the support mechanisms attached to that designation have real, if genuinely limited, practical significance for the economics of ownership. Banks designated as MDIs by the FDIC are eligible for certain specific forms of regulatory and technical assistance, and the FDIC itself has a formal program aimed at supporting the preservation and strengthening of minority depository institutions. The Treasury Department's Community Development Financial Institutions Fund provides grant and loan funding specifically available to CDFIs, a category that overlaps significantly with Black-owned community banks. And the Emergency Capital Investment Program, created during the pandemic, directed several $billion specifically toward MDIs and CDFIs, with a number of Black-owned banks in Atlanta and across the country receiving meaningful capital injections through that program. These mechanisms matter, and they have provided genuine, measurable support to institutions that might otherwise have faced more severe capital pressures. But they do not fully resolve the underlying structural capital challenge, and they are subject to the political and budgetary uncertainties that attend any government program, meaning the institutions that depend on them cannot treat them as a permanent, fully reliable foundation for their capital planning. Now, the technology and infrastructure dimension, because this is an area where the economics of scale create a genuine, growing competitive pressure on smaller Black-owned banks that deserves honest, direct attention. Modern banking customers, including customers in the communities that Black-owned banks serve, Expect a level of digital banking capability, mobile apps, online account management, digital payments, instant account access that requires significant, ongoing technology investment to deliver. The cost of building, maintaining, and continuously updating a competitive digital banking platform is substantial, and it is a cost that scales poorly with the size of the institution, meaning that a large bank with hundreds of billions in assets spreads the technology cost across an enormous revenue base, while a smaller Black-owned community bank with perhaps a few hundred million in total assets must absorb a technology cost that, while smaller in absolute terms, represents a considerably larger proportion of its total revenue. This creates a genuine, structural competitive pressure, because a Black-owned bank that falls behind on digital capability risks losing exactly the younger, more digitally engaged customers it needs to attract in order to grow its deposit base and sustain its long-term viability, while investing aggressively in technology to close that gap consumes capital and operating budget that might otherwise support expanded lending to the community. Several Black-owned banks, including institutions operating in the Atlanta market, have addressed this challenge through technology partnerships and shared service arrangements with other community banks or with specialized fintech providers, spreading the cost of digital infrastructure across multiple institutions and thereby achieving some of the scale economics that their individual size does not naturally provide. There is a dimension of the Atlanta market specifically that shapes the economics of Black-owned banking there in ways worth examining directly. And it is the remarkable demographic and economic transformation the city has undergone over the past 3 decades. Atlanta has experienced sustained, significant population growth, a major expansion of its professional and corporate employment base, and a genuine, well-documented influx of Black professional and entrepreneurial talent drawn by the city's reputation as a center of Black economic and cultural life, a reputation built directly on the institutional foundations this breakdown has been describing. This demographic reality means that the potential customer base for Black-owned banking in Atlanta includes not simply lower-income community residents requiring access to basic banking services, but also a substantial and growing population of Black professionals, Black entrepreneurs, and Black business owners seeking banking relationships that reflect their values and support their community. Customers who carry meaningfully higher deposit balances, who require more sophisticated commercial and personal banking products, and who represent a genuine, commercially significant opportunity for Black-owned banks capable of serving them effectively. The challenge is that this same population is also actively courted by large mainstream banks, by national fintech companies, and by a growing number of institutions marketing specifically to Black consumers without being Black-owned, meaning that competition for the most commercially attractive segment of the potential Black banking customer base in Atlanta is genuinely intense. And Black-owned banks cannot assume community loyalty will translate automatically into customer retention without delivering the product quality, digital capability, and service experience those customers can obtain elsewhere. Now, the branching and physical presence economics, because this carries particular weight in a city as geographically spread as Atlanta, where the distance between the historically Black communities of Southwest Atlanta and the growing suburban communities of DeKalb County, or the mixed-income neighborhoods emerging around the Beltline, represents genuine, real barriers to banking access for customers without reliable transportation. A bank branch is an expensive piece of infrastructure to operate, requiring physical space at commercial lease rates, staffing across all operating hours, ATM infrastructure, security systems, and ongoing maintenance. And the economics of branch banking have been under sustained pressure across the entire industry. as digital banking has shifted an increasing proportion of routine transactions away from physical branches and toward online and mobile channels. For a smaller Black-owned bank or the Staatsraum, the decision about where to locate branches and how many to operate involves a genuine, difficult trade-off between the mission imperative of providing accessible physical banking presence in underserved communities and the commercial imperative of managing the fixed cost of branch operations within the constraints of a smaller revenue base. Closing a branch in a community that has limited alternative banking access creates genuine harm to exactly the people the bank was built to serve. Maintaining that branch when its transaction volumes do not justify its cost creates genuine pressure on the bank's overall financial performance. This is another specific manifestation of the central tension this breakdown has identified as the defining challenge of Black-owned bank economics. And it has no clean resolution, only a continuous, difficult, contextual judgment about where the line between mission and sustainability actually sits on any given day. There is a further dimension worth examining, and it is the role that deposits from large corporations, anchor institutions, and government entities can play in strengthening the deposit base and financial stability of Black-owned banks, a mechanism that received considerable public attention during and after the racial justice reckoning of 2020, when a number of major corporations announced commitments to move significant deposit balances into Black-owned financial institutions. These corporate deposit commitments, when they are genuine, sustained, and of meaningful scale, can provide a real, measurable strengthening of a Black-owned bank's deposit base, increasing the lending capacity of the institution and improving its overall financial stability. Several Black-owned banks in Atlanta and across the country received meaningful deposit commitments from corporate partners following 2020, and a number of those commitments translated into genuine, lasting banking relationships rather than one-time gestures. However, the impact of these corporate deposit programs has been uneven, with some commitments proving more durable and more strategically integrated than others, and with the overall scale of corporate deposits moving into Black-owned banks remaining modest relative to the total capital needs of the sector. The more durable opportunity may lie not simply in deposit placement, but in deeper, more comprehensive corporate banking relationships, treasury management, commercial lending partnerships, and loan participation arrangements that allow Black-owned banks to participate in larger transactions than their own capital base would independently support, building both revenue and institutional capacity in ways that a deposit relationship alone does not. Now, the genuine wealth-building potential of Black-owned bank ownership itself, because this is a question that sits at the heart of what this channel is about. Owning a bank, even a smaller community bank, can be a genuine wealth-building enterprise if the institution is well managed, if it achieves sustainable profitability, and if it is able to grow its asset base over time, generating returns on equity that justify the capital invested, and potentially appreciating in value as an asset that a larger institution might seek to acquire. The history of bank acquisitions in America includes numerous examples of community banks, built over decades by their founding ownership groups, being acquired by larger regional or national institutions at prices that generated meaningful financial returns for those original owners. For Black-owned banks, however, the acquisition path carries a specific complexity, because a Black-owned bank acquired by a larger mainstream institution is no longer a Black-owned bank. And the community banking mission, the relationship-based lending in underserved communities, the physical presence in neighborhoods that mainstream banks have historically avoided, may not survive the transition to a larger institution whose strategic priorities and underwriting standards are shaped by a different set of considerations. This means that the genuine wealth-building potential of Black-owned bank ownership in Atlanta exists in some tension with the mission preservation imperative, and that the ownership groups of Black-owned community banks must navigate that tension explicitly as they plan for the long-term future of their institutions. So let us put all of this together and state clearly what the economics of owning a Black-owned bank in Atlanta actually look like. When you sit with the genuine numbers and the genuine structural realities, the deposit base serves a community whose average balances are lower than the broader market, creating higher per-dollar operating costs. The lending mission requires serving borrowers and communities that carry higher measured credit risk, creating pressure on loan loss provisions and capital adequacy. The technology investment required to remain competitive consumes a disproportionate share of a smaller institution's revenue base. The capital-raising environment is genuinely more constrained than for larger mainstream institutions, with MDI designation and CDFI programs providing real but limited and uncertain support. The competitive environment in Atlanta has intensified as both mainstream banks and fintech companies have recognized and begun actively marketing to the city's growing Black professional and entrepreneurial population. And the branching economics force a continuous, difficult trade-off between mission-driven physical presence in underserved communities and the commercial sustainability of the overall institution. Against all of that, the Black-owned banks that have survived and sustained themselves in Atlanta over decades, institutions like Citizens Trust with its century of continuous operation, have demonstrated that this enterprise is genuinely viable, that the mission and the commercial survival requirement can be threaded together by institutions with strong management, clear strategic focus, genuine community relationships, and the kind of patient, mission-aligned capital and partnership support that allows them to weather the inevitable, difficult periods without losing their institutional identity or their community anchor role. They have survived because the communities they serve have understood at the deepest level what this channel keeps documenting across industry after industry, that ownership of the institutions that control capital, that decide who gets a mortgage and who gets a business loan and who gets access to the financial infrastructure that wealth building requires, is not simply a commercial question. It is a structural question about who holds economic power and who shapes the terms on which an entire community participates in the broader economy. So if you are thinking about why Black-owned banks in Atlanta matter, why their survival is worth understanding, and why the economics of keeping them viable deserve the kind of serious, detailed attention this breakdown has tried to provide, remember the single thing that ties all of it together. It was never simply about banking. It was always about who controls the capital, who decides where it flows, and whether the communities that built these institutions against the full weight of exclusion and disinvestment will continue to have institutions that answer to them, that are built for them, and that exist to ensure that the next generation of Black entrepreneurs and Black families in Atlanta has somewhere to go when they are ready to build. If this kind of breakdown helps you see the real structure behind wealth and ownership in America, that is exactly what this channel is built around. Subscribe to Wealth Forge Black for more deep dives into how ownership, capital, and opportunity really work behind the scenes, and turn on notifications so you never miss the next